In this example, we're going to look at warranty transactions. So we have a company, Lee Company, that sells coffee grinders. They purchase the coffee grinders from one company and then sell. The grinders have a 60-day warranty. So when a grinder is returned, the company discards it and mails a new one for merchandise inventory to the customer. Our cost per grinder is $24 and the retail selling price is $50. We expect warranty costs to equal $10 of dollar sales. Okay, so on November 16th, we're going to record all of these journal entries. On November 16, we sell 50 coffee grinders for cash. So we have cash and sales. Okay, 2,500 cash and 2,500 in sales. Then we also need to record the cost of goods sold, which I'm going to abbreviate, and the inventory amount. So it's $24 each times 50 coffee grinders. So our cost of goods sold and our inventory amount is $1,200. Then on November 30th, we're going to record warranty expense for November with an adjusting entry. So we're going to record a warranty expense of $250 because that's 10% of sales. So we have November 30th. We make adjusting entry. So we have warranty expense, and then we have estimated warranty liability. And I'm going to have to move my debits and credits here. So 250 and 250. Let's move these over here so they match. So we have our debits and credits. Okay. On December 12th, we replaced 6 grinders that were returned under the warranty. So on December 12th, we have 6 grinders, so 6 times $24. We're going to debit our estimated warranty liability and credit inventory because we take them out of inventory. And so 6 times 24 is 144. Make that just a little bit longer. On December 18th, we sell 200 grinders. So we record the sale of cash, $10,000. It's sales revenues of $10,000. And we also, the COGS and the inventory that we remove. So our cost of goods sold and inventory, 200 grinders at $24 each is $4,800. On December 31st, we need to do that adjusting entry. Okay, so that's our warranty expense. Oh, on December 28th, first we have to record that we replaced 17 grinders that were returned under the warranty. Okay, so we have this estimated warranty liability and inventory, and this is for 17 grinders. So 17 times 24 is 408. We're going to do a debit and a credit, Now on December 31st, we're going to record that adjusting entry for our warranty expense and add that to estimated warranty liability. Okay, 10% of sales, December sales. So we had sales of $10,000. 10% of $10,000 is $1,000. So we have a debit for $1,000 to warranty expense and a credit to estimated warranty liability of $1,000. On January 7th, we sold more grinders. So we record this. I'm actually going to copy this and change the dollar amount. So 40 grinders for $2,000 cash. And then the value of those grinders, 40 times 24 is $960. On January 21st, we replaced the 36 grinders that were returned under warranty. So January 21st, we have estimated warranty liability and inventory. So we have 36 grinders times $24 a piece, or $864. And then on the 31st, we're going to record our warranty expense related to January sales. So on January 31, we have warranty expense. And I spelled that wrong. And estimated warranty liability. $2,000 in sales in January. 2,000 times 10% is 200. So now we've recorded all of the journal entries for those. Then the last thing we want to know is, what is the balance of the estimated warranty liability account on December 31st, and what is the balance on January 31st? Well, the easiest way to do this is to really just build a T account. Okay, so let's make this T account. I'm trying too hard for debits and credits. It's not that difficult. Okay, so first we have a credit of $250, and then we have a debit of $144. Then we come down and we have a debit of $408. And then we have a credit of $1,000. Okay, so now we want to know, what is the December 31st balance? So we're going to have the sum of our credit side minus the sum of our debit side. So we have a balance of $698 in December. And then in January, we have a debit of $864 and a credit of $200. So the January 31st balance is the sum of the credit balance minus the sum of the debit balance. Whoa. Yep, so $34. Okay, I'm actually going to finish off the last couple because they're pretty short in this video rather than starting a new video. In this, we have estimated liabilities. So the first estimated liability that we have is vacation pay. So we have employees that earn vacation as a benefit, and then we can't record that. It's a liability to us until the employees actually take the vacation. So we need to record the expense in the period in which it happens, but then we have a vacation expense payable that we charge against when employees take vacation. So we would have vacation benefits payable or expense and vacation benefits payable as our journal entry with a debit of $13,000 and a credit of $13,000. The second example is a warranty expense, and so we want to record our warranty expense. So we have, when we do that adjusting entry, we have a debit to warranty expense and a credit to estimated warranty payable. The warranty expense, it says, is $15 per unit, and we sold 12,000 units. So 12,000 times 15 is, times 15 times 10% is $18,000. So we have warranty expense of $18,000. The next example talks about contingent liabilities. And what we want to know is when we have to report a contingent liability. And so a contingent liability is when we have the potential that there might be a liability, but there's no guarantee that it's going to happen. So what we have to do is we have to determine, do we need to record a liability? Do we need to disclose that liability in notes, or is there no disclosure? So in the first example, we have that we've signed on the loan of a supplier, and they currently owe us $100,000, and we believe they're going to pay it. So it is not probable that the supplier will default. We know they're good for that $100,000. But this is something that we would need to disclose in notes. We would have to put that we have this debt owed to us of $100,000, even though we believe it'll be paid. Okay. The second example, we have an employee that is suing us, and our legal advisors believe that the company will likely need to pay damages, but the amount cannot be reasonably estimated. So that's kind of the big important thing about whether this needs to be recorded or not, is if you can estimate the amount, it needs to be recorded as a liability. If you cannot estimate the amount, but your legal team is pretty sure you're going to lose the lawsuit, that needs to be disclosed in notes. If it would have said your legal advisors believe it's never going to go to court, then there would be no disclosure. Our last example is times interest earned. So times interest earned is a calculation that banks often look at, or creditors look at, before they loan money out to make sure that people can pay their debt. And so the calculation for times interest earned is income before interest and taxes divided by interest expense. So I'm actually going to just put that right here. I'm going to insert a couple rows, and I'm going to put our times interest earned for this company. So it's income before interest and taxes divided by interest expense. And that's just a number. And then we have income before interest divided by interest expense. So Miller Company has a 3.33 and Weaver Company has a 1.54. Okay, so we have that information here. And then the next thing we want to know is what happens to each company's net income if sales increase by 30%. So we have this information here, and we're going to copy it over. And we're going to put it over here, and we're going to just do this kind of what if case scenario. Okay, so here we have sales of a 1 million times 1.3%. And that's because it's a 30% increase in sales. And same thing here, we're going to take 1 million times 1.3. Okay. So then what happens to our times interest earned? We take income before interest divided by interest expense. Okay. So now we see that improves for both companies. So it really is just kind of a how volatile are they, how dependent are they on sales in order to pay their bills, that kind of thing. This is also the reason why everything that you put in Excel should be a formula, is because it allows us to easily do this what if formula where we just change the amount of sales. So, and everything else in the income statement automatically changes because we have our formulas set up. So now let's change that to 1.5 to see a decrease in sales, or a 50% increase. So now we can see the impact that has. So net income goes up for both companies, and our times interest earned goes up for each company. Now, what happens if it decreases by 10%? So now instead of 1.5, we're going to take it times 0.9 and see a 10% increase in sales. So 0.9. Okay, so we see both positioned worsen, but the Miller Company still has a very good times interest earned. And now what happens if their sales decrease by 40%? So now instead of 0.9, let's take it times 0.6. I think Weaver Company might be in trouble then. Now Weaver Company has negative net income and their times interest earned is less than 1. They would be considered a not a good company to loan money to with that formula in case that happened. So that's just a good idea to see kind of some adjustments of what happens at different sales levels. And that's the end of chapter 9 examples.